Hello, my dear Forex students. Eric Were here. Welcome to lecture 4 of the LifeVersity Forex trading course. I'm very excited to have you in this fourth lecture. We have 16 lectures to go. So if you haven't gone through the introductory video or the first, second, and third lecture, you need to do that before you proceed with this lecture. Simply check the links in the description to jump on the bandwagon and be able to watch the introductory video and lecture 1 and lecture 2 and lecture 3 in order for you to clear the backlog and to be up to date with everything that I will highlight in this lecture. Basically, in lecture 4, I will introduce you to a very important foreign currency trading tool, that is the Japanese candlesticks, and I will be able to disclose to you the types of Japanese candlesticks and how to trade the Japanese candlesticks and how to ensure you always catch the trend with the Japanese candlestick. This is a very important trading tool in any foreign currency trader's toolbox, and this is one of the most important lectures you don't want to miss. Let us just head to the LifeVersity Forex trading timetable in order for us to go through the timetable before we can get started. And according to our LifeVersity Forex trading timetable, as you can see, lecture 4, we shall look at 3 parts. Part 1 is introduction to the Japanese candlesticks. Part 2 is types of Japanese candlesticks. Part 3 is how to trade using Japanese candlesticks. Without wasting much of your time, let us just head over to lecture 4. And as you can see in the screen, LifeVersity Forex Trading Course, lecture 4, part 1, Introduction to Japanese Candlesticks. As you can see in the screen, there are two types of Japanese candlesticks. We have a bearish Japanese candlestick and a bullish Japanese candlestick. And by bearish, I simply mean downtrending Japanese candlestick, and by bullish, I mean an uptrending Japanese candlestick. As you can see in the diagram, the Japanese candlestick on the bearish, which is the red one, you can see we have different parts of the Japanese candlestick. The middle part, that is the red, and the green part, that is the real body. And then for the bearish candle, as you can see, the red one, the opening price is up and then the closing price is low. Down there, that is the closing price, as you can see. And then we have the lower shadows, as you can see, and then we have the upper shadows. There are four important parts of any Japanese candlestick, and that is the opening price, very important, the closing price, thirdly the highest price, and fourthly the lowest price. So as you can see, the lowest price is similar for both bullish and bearish candlesticks, and the highest price is also the same, but the opening price is different. For the bearish candle, you can see the opening price is above the closing price, and for a bullish candle, the opening price is below the closing price, or the closing price is above the opening price. Basically, that is what you need to know about the Japanese candlesticks. Heading over to my trading chart, you can see I have them here on my chart. This is the Euro USD chart. I can simply navigate and switch over to another chart, maybe the USD CAD or the United States dollar, Canadian dollar. As you can see, I have them over here, and the red ones for me are the bearish candlesticks, the green ones are the bullish candlesticks. And just like in the diagram in our lecture, you can see here we have a bearish candlestick, and up here we have the highest price, and then at the bottom here we have the lowest price. And then this is the body, the red part. We have the opening price for the bearish candle up here, and then we have let me just sketch with the horizontal line. The opening price for a bearish candle, this candle here, is up there. The closing price is at the bottom. And then, as I said earlier, the lowest price is also at the bottom and the highest price is at the top. For the bullish candle, the opening price is below here, down here, and the closing price is up here. The lowest price is down here and the highest price is up here. Basically, that is what you need to know about the Japanese candlesticks. I have attached the PDF document. You can refer to it from time to time to back up what you're learning in this lecture. This is a very important tool that you need in your trader's toolbox, and what the Japanese candlestick does is simply helping you to predict price action. It shows you price action. What is happening? Is the price going up or is the price going down? For example, for a currency pair like the USD card or the United States dollar, Canadian dollar, you can see the red candle simply indicates that the price is dropping, and for that matter, if you are selling the USD card, you'll be making profit. On the other hand, the green candle indicates that the price is going higher, and if you're buying the USD card pair, you'll be making profit. That is the most important aspect of the Japanese candlestick pattern. As I said earlier, there are two types of Japanese candlesticks. They are bullish candle. A bullish candle is formed when the closing price is above the opening price. A bullish candle indicates buying pressure, very important. And then we have a bearish candle. It is formed when the closing price is below the opening price. A bearish candle indicates selling pressure. Then the difference between a long and a short candle, as you can see here, a long candle signifies high market volatility and a short candle low market volatility. We can just go back to the chart. You can see we have long and short candles, like this candle over here where I'm just viewing it with the arrow. You can see it's very long, a bearish candle that is long. And then we have smaller candles like this one over here. So the long candle indicates high buying or selling pressure or volatility, and then a small candle indicates low buying or selling pressure or low volatility. That is the main difference between these Japanese candlesticks pattern. Advantages of Japanese candlestick patterns: one, it gives early signals of potential market turns. So the Japanese candlestick can predict to you the potential turn in the market, as we will see in the different types that I'll discuss with you in the following pages. It provides unique insights on the relationship between buyers and sellers. You can be able to see whether buyers are coming out stronger or sellers are coming out stronger or weaker or vice versa. Thirdly, it contains unprocessed and raw data about the market sentiments. Very important. This is a very important tool you need in your trader's toolbox if you want to make any step in your foreign currency trading journey. I'll go to part 2, popular types of Japanese candlestick patterns and how to trade using the patterns. There are different types of Japanese candlesticks pattern, and as you can see in the chart here, for instance, this pattern over here is different, very different from this one, because this green one has a full body, like a full body, and even this red one here has like a full body. And as you can see, the other one I'm hovering my mouse over has a long red body, but it also has a wick, that is a shadow, a long shadow. They are different, and you are going to learn them in this section. So the different types of Japanese candlestick patterns: the first one, we have a dragonfly doji. It indicates buying pressure. It is a bullish candle. As you can see, it looks like a letter T. We can search it over here and see if we can have it. This is like an example of a dragonfly doji. Let's just head over and see what contains the dragonfly doji, how to recognize it. There must be a preceding downtrend. It looks like a T letter. The opening, highest and closing price are the same. As you can see, the opening, highest and closing price are the same around the horizontal line of the T. And then we have, it has no real body but a long lower shadow or a wick. What is the psychology behind the dragonfly doji? When the market opens, the bears drag the price all the way down, resulting in a long lower shadow. The bulls fight strongly and eventually manage to push the price back up to the opening level. The longer the lower shadow, the more effective the bullish signal. It tells us that the bulls are strong enough to conquer the bears who once dragged the price so low. How do we trade it? Look for the dragonfly doji at the bottom of a downtrend. Wait for the next candle to close above the high of the dragonfly doji to confirm the existence of a bullish force. Open a long position. Upon confirmation, place a stop loss below the low of the dragonfly doji. That is basically how we trade the dragonfly doji, and it can be found at the bottom of a downtrend. As you can see here, we have one, and it is an indicator that bulls are coming to control the market. As you can see, there was a downtrend, and this candle over here, it dropped, and then immediately the bulls started pushing the price higher and higher, and then it formed this pattern here, similar to a dragonfly doji. And from there, another red candle formed, then a green candle, or a bearish candle, that the red one, then a bullish candle, and then there was some sort of buying pressure. But as you can see, we have the blue line here, that is the 100-hour moving average, that acted as a point of resistance. The price couldn't go any higher than the 100-hour moving average. That is why it was contained, and after trying to break the 100-hour moving average, it was like a false breakout. The price dropped again and kept dropping up to this level, that is up to this level here. That is 1.33655. That is a level of support, and then the price bounced back and broke the 100-hour moving average. It went on and broke the 50-hour moving average, and since then it has been bullish. It dropped again, and now it's below the 100-hour moving average. That is on my 1 hour chart. Let's head over to the second pattern, a hammer stroke bullish. It is a bullish pattern. As you can see, let's look for a hammer from our chart, and I can locate one here. This one is a hammer, and basically a hammer tells you that the bulls are in control again. How to recognize it? There must be a preceding downtrend. On the Euro USD, you can see there is a downtrend. Then we have a hammer here. Here it is. So let's just see how to recognize it and how to trade it. There must be a preceding downtrend. As you can see, there was a downtrend over here, and then a hammer formed. Let's go on. It looks like a square lollipop with a long stick. The closing price is above or near the opening price, forming a tiny body. The real body could be green or red. It has no or little upper shadow. The lower shadow is at least twice the length of the real body. What is the psychology behind it? Similar to the dragonfly doji, when the market opens, the bears continuously drag the price down during the session, resulting in a long lower shadow. The bulls fight strongly and conquer the bears by pushing the price above or near the opening level, forming a little square body. The longer the lower shadow, the more effective the bullish signal. It tells us that the bulls are strong enough to conquer the bears who once dragged the price too low or so low. How do we trade it? Look for the hammer at the bottom of a downtrend. Like in this case, at the bottom of a downtrend, here is the hammer. Any downtrend, you can be able to find a hammer, like here, like here. They are very easy to locate on any trading chart. Wait for the next candle to close above the high of the hammer to confirm the existence of the bullish force. For instance, as you can see in this chart here, when this hammer formed, another green candle formed to confirm bullish force, but unfortunately it was a false breakout. As you can see, there is a trend line here, or a Fibonacci level of 50%. So when it hit that level, the price dropped again. That's why it's very important to use Japanese candlesticks together with other tools like the Fibonacci, the moving averages, in order for you to identify earlier on the points of support and the points of resistance. The different Fibonacci levels represent either the points of support or points of resistance. For instance, as you can see here, this 50% level of Fibonacci, the price could not break that level. And if you are to trade using a Japanese candlestick pattern, at least you'll be having another secondary tool to help you see that if the price breaks the 50% level, then it is poised to keep going higher. If it doesn't break, you can simply place your stop loss slightly below the 50% level, and you can be able to check out with a small loss and be able to hang on the next trade. Of course, if you open a trade if you short at the 50% level, you will have made some profit of a few pips here before the market touched this horizontal line and started retracing back to 38.2 level of Fibonacci. Let's head over to the third candlestick pattern, the gravestone doji. That is a bearish pattern. As you can see, it is the opposite of the dragonfly doji. The dragonfly doji, as you saw, it's a T, and the third one, which is the gravestone doji, is like the opposite, an inverted T. It indicates selling pressure. How do you recognize it? There must be a preceding uptrend. It looks like an inverted T. The opening, lowest, and closing price are the same. It has no real body but a longer upper shadow. What is the psychology behind it? When the market opens, the bulls push the price all the way up, resulting in a long upper shadow. The bears fight strongly and eventually manage to drag the price back down to the opening level. The longer the upper shadow, the more effective the bearish signal. It tells us that the bears are strong enough to conquer the bulls who once drove the price. How do we trade it? Look for the gravestone doji at the top of an uptrend. Wait for the next candle to close below the low of the gravestone doji to confirm the existence of a bearish force. Open a short position upon confirmation. Place a stop loss above the high of the gravestone doji. If I'm going fast, I don't need to worry. We have this document sent just below the link of this video. You can simply download it and be able to refer to it later on. Heading over to our chart, let's just try locate the gravestone doji, and we can only locate it at the height of an uptrend. As you can see here, we have some kind of uptrend, and as you can see this pattern here, it's kind of a gravestone doji, an inverted T, and from there, as you can see, it formed, and then the next candle was bearish, and from there henceforth the market has been bearish. And then after a moment, after around 4 candles, after breaking this blue line, the 200-hour moving average, the market was able to reverse, and it is now bullish. That is the gravestone doji. Let's just head over to the next pattern. For the shooting star, it is a bearish candle. As you can see, this is the shooting star. It can be either bullish or bearish. How to recognize it? There must be a preceding uptrend. It looks like a flying meteor carrying a long tail. The closing price is below or near the opening price, forming a tiny body. The real body could be green or red. It has no or little lower body. The upper shadow is at least twice the length of the real body. What is the psychology behind it? Similar to the gravestone doji, when the market opens, the bulls continuously push the price up during the session, resulting in a long upper shadow. The bears fight strongly and conquer the bulls by dragging the price below or near the opening level, forming a little square body. The longer the upper shadow, the more effective the bearish signal. It tells us that the bears are strong enough to conquer the bulls who once drove the price so high. How do we trade it? Look for the shooting star at the top of an uptrend. Wait for the next candle to close below the low of the shooting star to confirm the existence of a bearish force. Then open a short position upon confirmation. Place a stop loss above the high of the shooting star. Just revisiting the shooting star, this is how it looks like. Let's head over to our pattern to see if we can recognize it at the peak of an uptrend. As you can see here, it is beautiful. This is the shooting star. It indicates selling pressure. Immediately a second bearish candle formed that was now an opportunity to sell. It indicates that there is some selling pressure. The fifth Japanese candlestick pattern, bullish engulfing. That is a bullish candle. As you can see, we have a small red candle, that is a small bearish candle, and a larger bullish candle. How to recognize it? There must be a preceding downtrend, a shorter red candle followed by a longer green candle, or a shorter bearish candle followed by a longer bullish candle. The green candle opens lower and closes higher than the red candle, as you can see. What is the psychology behind it? The red candle implies the control of bears following a prolonged downtrend. In the next session, the market opens below the low of the red candle, suggesting continuation of bearish forces. The bears then lose momentum. The bulls take charge. In the next session, the market opens below the low of the red candle, suggesting continuation of bearish forces. The bears then lose momentum. The bulls take charge and lead the price up during the session and eventually manage to close above the high of the red candle. The bulls have now fully overridden the bears. How do we trade it? Look for the bullish engulfing at the bottom of a downtrend. Wait for the next candle to close above the high of the green candle to confirm the existence of a bullish force. Open a long position upon confirmation. Place the stop loss below the low of the green candle. We just head over to our chart so that we can locate it. It's usually located at the bottom of a downtrend, the bullish engulfing. Here it is. As you can see, in the lecture we said it can't be located. Look for a bullish engulfing at the bottom of a downtrend. Very important. And in this chart you can see at the bottom of this downtrend we have the bullish engulfing, a small red candle followed by a big green candle, a small bearish candle followed by a large a bullish candle. That is a bullish engulfing. It indicates buying pressure. As you can see, immediately the bullish engulfing formed, the price kept going higher and even went ahead and broke this blue line, the 100-hour moving average. The price went ahead and broke the 50-hour moving average before hitting this point of resistance, 1.34146, and then it has been dropping since then, indicating that it is now a bearish trend. Let's head over to the next pattern, that is piercing bullish. Number 6, how to recognize it. As you can see, this is a piercing bullish. How to recognize it? There must be a preceding downtrend, so you find it at the bottom of a downtrend. A red candle followed by a green candle. The green candle opens with a gap down and closes at 50% or above of the real body of the red candle. What is the psychology behind it? The red candle implies the control of bears following a prolonged downtrend. In the next session, the market opens below the low of the red candle, suggesting continuation of bearish forces. The bears then lose momentum. The bulls conquer and lead the price up during the session and eventually manage to cover 50% of the losses or more from the previous session. How do we trade it? Look for the piercing at the bottom of a downtrend. Very important. Wait for the next candle to close above the high of the green candle to confirm the existence of a bullish force, and then open a long position upon confirmation, and then place a stop loss below the low of the green candle. The piercing is a bullish signal. You locate it below a downtrend. Let's just head over to our charts and see if we can locate one. As you can see, we have a red candle and then the green candle, or a bearish candle, then a bullish candle forming the bottom of this downtrend, and it is followed by an uptrend until the 100-hour moving average line was broken, and then it was like a false breakout, and then the price kept dropping before forming what we call the bullish engulfing and going high, then dropping later on my 1 hour chart of the USD Canadian dollar. Let's head over to the next pattern. Pattern number 7, tweezer bottom. That is a bullish pattern. As you can see, a tweezer bottom, it can either be a bullish candle or a bearish candle. How to recognize it? There must be a preceding downtrend, a red candle followed by a green candle. Both candles have the same low. What is the psychology behind it? The candles in both sessions form the same low, suggesting that the market refuses to go below that price level. Once the price touches the floor, it bounces back. That price level may be viewed as a short-term support. The closing price of the green candle shies away from the lower further than the red candle does. It shows that the bullish forces are getting stronger. How do we recognize it? Look for the tweezer bottom at the bottom of the downtrend. Very important. And then wait for the next candle to close above the high of the two candles to confirm the existence of the bullish force, and then open a long position upon confirmation. Place a stop loss below the low of the two candles. This is a tweezer bottom. Let's just try locate it on our chart. I'm seeing a tweezer bottom now here, As you can see, this candle, the green one and the red one, they can't go below this horizontal line, the price level of 0.90908 on my USD Swiss franc chart, 1 hour chart, and this is a tweezer bottom. It is a bullish Japanese candlestick pattern indicating buying pressure, and as you can see in the chart, the moment the tweezer bottom was formed, the price kept going up and up until it broke this line, that is the 50-hour moving average, and went further to break the 200-hour moving average. So this tweezer bottom here, the green and then the red candle, or the red candle and the green candle, indicate buying pressure. We head over to the next pattern, that is the bearish engulfing, the opposite of bullish engulfing. Here it is, a green candle first, a small green candle, or a small bullish candle followed by a big bearish candle. In the case of bullish engulfing, there was a small bearish candle followed by a big bullish candle. How to recognize it? There must be a preceding uptrend, a shorter green candle followed by a longer red candle. The longer red candle opens high and closes lower than the shorter green candle, completely engulfing it. That is why it's called bearish engulfing. The bearish candle engulfs the bullish candle completely. What is the psychology behind? The green candle implies the control of bulls following a prolonged uptrend. In the next session, the market opens above the high of the green candle, suggesting continuation of the bullish forces. The bulls then lose momentum. The bears take charge and send the price down during the session and eventually manage to close below the low of the green candle. The bears have now fully overridden the bulls. How do we trade it? Look for the bearish engulfing at the top of an uptrend. Very important. Wait for the next candle to close below the low of the red candle to confirm the existence of bearish force. Open a short position. Upon confirmation, place a stop loss above the high of the red candle. Let's just head over to our chart and see if we can locate the bearish engulfing at the top of a trend. As you can see, here it is. This is a bearish engulfing, some sort of bearish engulfing. The small green candle and then the bigger red candle indicating selling pressure, and as you can see, the moment it formed, the price kept dropping, and since then it has been dropping. Another example of bearish engulfing is right here. Can see the green candle and then the bigger red candle, and then the price has been dropping. The opposite of bearish engulfing, you can see it here, a small red candle, then a bigger green candle, that is the bullish engulfing. Number 9, the dark cloud cover. It is a bearish pattern. You can see it. How to recognize it? There must be a preceding uptrend, a green candle followed by a red candle. The red candle opens with a gap up and closes at 50% or below the real body of the green candle. What is the psychology behind it? The green candle implies the control of bulls following a prolonged uptrend. In the next session, the market opens above the high of the candle, suggesting continuation of the bullish forces. The bulls then lose momentum, the bears take charge and send the price down during the session and eventually manage to wipe out 50% of the gains or more from the previous session. How do we trade it? Look for the dark cloud cover at the top of an uptrend. Very important. Wait for the next candle to close below the low of the red candle to confirm the existence of a bearish force, and then open a short position upon confirmation and place your stop loss above the high of the red candle. Well, this is our dark cloud cover. We locate it at the top of an uptrend, a bullish candle, then a bearish candle forming like here. This is a good example of the dark cloud cover. It is a bearish pattern. You can view it here, right here at the top, or at the top of this uptrend in my Great Britain pound United States dollar 1 hour chart. Let's head over to the next pattern, and that is the tweezer top, the opposite of the tweezer bottom. The tweezer top is a bearish pattern. How to recognize it? As you can see how it looks. There must be a preceding uptrend, a green candle followed by a red candle. Both candles have the same high. What is the psychology behind it? The candles in both sessions form the same high, suggesting that the market refuses to go above the price level. Once the price touches the ceiling, it retreats. The price level may be viewed as a short-term resistance. The closing price of the red candle shies away from the high further than the green candle does. It shows that the bearish forces are getting stronger. The tweezer top is just an indication of a short time resistance, and as you can see, it forms where there is some sort of resistance, and it is a clear indication that the bears are gaining momentum. Let's just look at the top of an uptrend. As you can see in this chart, this candle here and the other one forms a tweezer top because there's some kind of temporary resistance at the 200-hour moving average. So this is what we call a tweezer top. It's a kind of a tweezer top. From there henceforth, you saw, as you can see, the price kept dropping because of this type of resistance. There was some sort of consolidation or non-trend there, or sideways movement of the market because of this 200-hour moving average on my chart of the USD card 1 hour chart, and that is what we call the tweezer top. It indicates selling pressure or the bearish forces are in control. How do we trade it? Look for the tweezer top at the top of an uptrend. Wait for the next candle to close below the low of the two candles to confirm the existence of the bearish force. Open a short position upon confirmation. Place a stop loss above the high of the two candles. That is how we trade the tweezer top. And those are basically 10 most important Japanese candlestick trading patterns you need to look out for in the market. As I've been showing you on my charts, you can be able to visualize them, and you can see them at the top, either at the top of an uptrend if it is a bearish candlestick pattern, or at the bottom of a downtrend if it is a bullish candlestick pattern. Very important trading tool. If you are able to master the Japanese candlestick patterns, you can be able to use it in conjunction with the other technical analysis tools like the moving averages, as you can see, the Fibonacci and the trend lines, in order to predict the direction of the market. In order for you to be able to go through them again, remember I have a PDF document just below the link to this video. Go back to your email and be able to download that PDF and revisit all those patterns in this document that I have prepared for you. If you're wondering how to customize the color of your candlestick patterns, it means you missed lecture 3, but I'll just go over it again in this lecture, but ensure you go back to lecture 3 and you'll be able to see how to customize your candles. You simply choose the currency pair you want to customize. For instance, I want to do it on the Euro USD on the 1 hour chart. I simply right click in the chart and then head over to properties at the bottom here, and then under properties you can change the bull candle and the bear candle. You can use whichever color you want. I prefer my bear candles being red to indicate that I'm shorting or the market is dropping, and the bull candle to be green to indicate that the market is going up. You can customize the color, you can even customize the background and much more. That is how you can change the color of your candlestick patterns. If you are using the bar charts, then you don't have to worry about the candlesticks. If you are using a line graph, again you don't have to worry about the Japanese candlesticks. But the Japanese candlesticks is the real tool because it is able to help you predict the direction of the market and, most importantly, price action. Using price action in conjunction with technical analysis tools like the moving averages, the trend lines, and the Fibonacci, you can be able to have a clear picture of the trend. Again, you can be able to have a clear picture of the risk you can take. You can define your risk, and most importantly, you can be able to determine the direction of the market. The biggest thing that any trader needs to determine in order to be profitable. That's it for this video, guys. See you again in the next video where I'll be sharing another amazing topic, that is lecture 5. Ensure you check your email tomorrow for lecture 5, be able to watch the video and then be able to check out the document, the PDF document similar to the one we have gone through today, and you will be able to connect the gaps in between using the video and the document that I have sent you through email. Until next time, guys, stay safe and may God bless you. See you tomorrow in lecture number 5.